The gig economy has never exactly been flawless, but some recent trends are throwing off a delicate balancing act between workers and customers that might accidentally be exposing some much deeper underlying problems. On the surface, our unemployment rate looks really good right now. Sure, it has trended up slightly in the wake of a long string of mass layoffs, but by zooming out, we can see it is still hovering around all-time lows. Sounds great, right? Well, it's no secret anymore that jobs data has had some reliability problems in recent years, and one of the biggest blind spots is people moving into the gig economy instead of becoming formally unemployed. For a lot of people who have lost their jobs, it's quicker and often easier to register as an Uber driver than it is to register as unemployed. And you only really need to look at the numbers to see this is happening. According to the Bureau of Labor Statistics, over the last 5 years, the total number of people classified as unemployed has fallen by about 3 million. That sounds good. But over that same time frame, the number of active Uber drivers has increased by roughly 3 million people, according to company financials. Now, to play devil's advocate, even if these jobs aren't the best, having readily available and highly flexible work with low barriers to entry could actually be a good thing when the alternative is people going straight on to unemployment. And we will get to that, but the problem right now for workers entering the gig economy is that there is a rapidly growing roster of drivers looking for work and a shrinking pool of customers still willing to pay premium prices for convenience. A lot of the data surrounding gig work and even regular employment is disjointed, vague, and often downright counterintuitive. Even something as simple as what it means to be employed can differ depending on who is measuring it. When most people think of gig work, they imagine delivering food or driving passengers around. But depending on which organization is collecting the data, it can also include things like renting out property online or running small online businesses. When a metric becomes a goal, it stops being a useful measure. Gig platform companies want to report that lots of people are working for them to show how important they are to investors. Media outlets want big swings in employment numbers to generate headlines, and politicians often prefer to highlight statistics that make the job market look healthy. All of this creates a confusing picture that makes it difficult to understand what is actually happening for the majority of workers in these jobs, many of whom entered the gig economy because they couldn't find better alternatives. To understand what's really happening, there are 3 key pieces to examine: the platform economics that enabled the gig economy to grow, what these platforms may be masking in the broader job market, and what happens if they can no longer mask those problems. The first part comes down to platform economics. A platform like Uber Eats or DoorDash coordinates transactions between 3 groups: the delivery driver, the restaurant providing the food, and the customer placing the order. If the platform wants to increase profits, it has 4 options: charge customers more, pay drivers less, take a bigger cut from restaurants, or increase the number of transactions. In the early years, these companies focused almost entirely on the last option, growth. They subsidized transactions to attract users. Customers often received discounted meals, restaurants got generous revenue splits, drivers could earn solid hourly income, but those good times were funded by venture capital. Investors were willing to burn billions to establish dominance in the market. That approach is common when building marketplace platforms. Customers won't use an app with no restaurants, restaurants won't join without customers, drivers won't sign up without work, so the platform initially makes the deal attractive for everyone. Today, the focus has shifted. Instead of growing the number of transactions, companies are trying to increase how much they earn from each one, but how much pressure they can apply depends on how replaceable each group is.
The algorithms are set up in a way to charge the rider as much as it's possible and to pay the driver as little as possible.
I think people would be surprised to know that the guy you're delivering yours midnight sushi or whatever is like under the minimum wage.
At its worst is when it's very volatile work, when something happens to the provider and they have no protections.
Elon Musk's company launching its long-awaited self-driving taxi service in Austin, Texas, offering rides to a select group. The cost, a flat rate of $4.20 per ride.
Many of the latter having to work harder for less money and without the securities provided by traditional employment contracts, just because they're called contractors instead of employees or workers.
Over the last 2 years, customer spending on these platforms increased by roughly 35%, but the number of gig workers increased by about 80%. That means even if the revenue split stayed exactly the same, each driver would still earn less on average simply because there are more people competing for the same work. In reality, the revenue split has also changed. Drivers have become the easiest part of the system to replace, which means they are also the easiest group for platforms to squeeze. Pay is declining, waiting times between orders are increasing, and workers often spend hours waiting for gigs. Meanwhile, customers are increasingly questioning whether it's worth paying double the cost of a meal just to have it delivered across town. This creates a dangerous feedback loop. If customers cut back spending, drivers get fewer jobs. If drivers earn less, more people must work longer hours to compensate. Another factor shaping this dynamic is interest rates. In the past, the delivery market had intense competition from dozens of startups trying to gain market share. But most of those companies either went out of business, merged with larger competitors, or were acquired. The strategy of burning investor money to dominate the market only worked when borrowing costs were extremely low. Today, launching a competitor would be much harder because funding is more expensive. This leaves a small number of dominant platforms controlling the market, and the risks grow if job losses continue. If more workers enter gig platforms while consumer spending declines, even more people will compete for fewer opportunities. That dynamic is typical during economic downturns. Businesses lay off workers, households spend less, revenue falls, businesses cut jobs again. Gig work can temporarily soften that cycle because people who lose jobs can quickly start earning income through these platforms. But that same flexibility can also hide deeper economic problems. Traditional layoffs require paperwork, restructuring, and public disclosure. Gig platforms can reduce worker earnings instantly through algorithms. Fewer orders automatically mean fewer opportunities. Today, companies like Uber, Lyft, and DoorDash collectively represent one of the largest labor forces in the United States. If gig drivers were counted as employees, Uber alone would rival the largest employers in the world, and this trend extends beyond food delivery. Platforms like Fiverr, Etsy, and Amazon Flex have seen large increases in workers offering services online. Even the number of people creating online content has expanded dramatically as individuals search for alternative income streams.
30% of gig workers do assume that they will never retire. 77% of gig workers assume that they will rely on personal savings to get by.
Gig economy workers are, in many cases, entitled to absolutely nothing from the company that they work for.
The challenges faced by gig workers are well documented, but what we may soon discover is that the consequences extend far beyond the people doing the work. China offers a glimpse of what that future might look like. Following economic slowdowns and a surge in new graduates entering the workforce, millions of young workers turn to gig platforms. Today, estimates suggest China has around 200 million gig workers, as much as 40% of the urban workforce. 15 years ago, these platforms barely existed, but as economic conditions weakened, more workers entered the system while household spending slowed. Drivers now report spending up to 10 hours waiting to earn what previously took only 3 hours. Large groups of delivery riders waiting outside malls have become a visible symbol of deeper economic stress. Some workers remain active 10 hours a day, 7 days a week, yet still struggle to afford basic living costs. Competition has even led to conflicts between riders working for different platforms. While most Western economies have not reached that level yet, the structural forces driving the trend are similar. And another factor could make the situation worse: automation. Companies are aggressively developing technologies to replace gig workers entirely. Robot taxis could replace rideshare drivers. Autonomous delivery machines could replace couriers, and AI-generated content could replace creative gig work online. For workers already relying on these jobs to survive, that creates a troubling scenario. If economic conditions worsen, demand for services like food delivery could collapse. But if automation succeeds, the jobs themselves may disappear. Either outcome presents serious challenges for the people most dependent on gig work. The gig economy helped millions earn income quickly and flexibly, but it may also be hiding deeper structural issues in the modern labor market. And if those problems eventually surface, the effects could extend far beyond the gig workers themselves.